So our topic class would be accounts receivable, and accounts receivable is the first of many topics under the broader category of receivables class. There are a lot of kinds of receivables, and the most commonly used account would be your accounts receivable. Okay, but expect and understand that there will be additional discussions on different and various kinds of receivables class. Receivables are governed in part by PFRS 9 class, and the measurement requirements are found in PFRS 9. Your accounts receivable class, from the name itself, is a form of a receivable. It represents your right to collect, to make collections, to receive money from your customers or clients. The reason why accounts receivable is the most commonly used kind of receivable class, it's because it arises primarily from the main or principal operations of the entity. You will be using the accounts receivable title account. You will be using the accounts receivable account for transactions or for receivables arising from the regular course of your business. Okay, if you've read your textbook class, you have two major kinds of receivables, your trade and non-trade receivables. Your accounts receivable class fall under the category of your trade receivables, principally because, again, it arises from the regular conduct of your operations. Anytime you are engaged in your primary business or activity class, any resulting receivable from that transaction will be reported or recorded as an accounts receivable. Another common form of a trade receivable class would also be your notes receivable. But as you may have seen in the discussion in the notes receivable class, the primary difference there is in the form by which these two receivables take. Your accounts receivable class are normally verbal in nature class. There is no commercial document that represents or evidences your accounts receivable. These simply arise from the regular conduct of your business transaction. Whereas your notes receivable will generally be evidenced by a commercial document, normally a promissory note. Either way, both of them, in any case, both of them will represent a right to collect clause. Okay. To some extent, we can say your notes receivable is more secure as it is evidenced by a commercial document. But regardless, your receivables, your account receivables, and your notes receivable represent a right, a contractual right to receive cash or any other form of asset. Okay. But again, our focus here would be on the accounting for accounts receivable class. Unlike the other topics, the discussion on journal entries for accounts receivable would be plenty and heavy class. I will share to you later the discussion on cash. We rarely tackled on the journal entries revolving around cash class. As I have mentioned before, when we are dealing with cash, it's either it will increase or decrease, and cash will increase when you receive cash. Cash will decrease if you pay using cash. So the journal entries involving cash class are not very peculiar. It's very, as long as you're okay already as to the normal balances of accounts, you will know when to debit and credit your cash account. The same is true supposedly for your accounts receivable class. Accounts receivable is an asset, so it will increase with a debit and decrease with a credit. Okay, and your accounts receivable will increase every time you make additional transactions wherein you allow your customers to pay on a later date. If you open an account for your customers class, if you allow them to pay you in a future date, then definitely accounts receivable, your right to receive cash will increase. And on the other hand, your accounts receivable will decrease every time your customer make payments. But the reason why the discussion on journal entries involving accounts receivable will be plenty It's because of the other accounts that are related to your accounts receivable. When we are talking about accounts receivable alone, the discussion would be very simple. Increase it every time you make additional transactions that are not in cash, and decrease it uh, every time you make collections, class. Okay. But the discussion on entries revolving accounts receivable would revolve around your the other related accounts, such as your allowance for doubtful accounts. Okay, and I'm hoping that everyone has encountered the account title allowance for doubtful accounts because they should have been introduced to you in your basic accounting. Okay, other accounts related to your accounts receivable would be your other kinds of allowances: allowance for discounts, allowance for freight, allowance for returns and allowances. Okay, and because of those related accounts, class, there can be a lot of scenarios wherein we will have to learn how to prepare the journal entries. Okay, you will have to know how to journalize a transaction that will result in a sales discount. Okay, I hope you understand that your account receivable will your accounts receivable will normally arise every time you make a sales transaction. That is, if you are engaged in a merchandising or selling company. Okay, if you're engaged in uh, providing services, you would still use accounts receivable for services that you have rendered that are not paid in cash. Okay, anytime you provide goods or services in the ordinary course of business and you are not paid in cash, then that transaction will normally result in accounts receivable. Okay. And sometimes your sales transaction class, you will offer your customers discount. And you will only be able to know whether your customers will be eligible for discount class depending on when they will pay. If they will pay within the discount period, then you will have to give them discount. And that will affect the amount that you will be able to collect from them. If they pay beyond the discount period, then they will not be entitled to any discount. Also, because of the nature of your business class, it's possible that you have made the delivery first to your customer and your customer will not be satisfied with the quality, or there is a damage on the goods that were delivered, not without the fault of the customer class. So your customer will have to return the goods that you have given to them, or even by virtue of the warranties that you provide to your customers may return the goods that you have previously sold. And because of such returns class, it is understandable that if they return the goods they have purchased class, that they will no longer be paying for it. And because it will affect the amount that they will be paying you, again, it will involve our accounts receivable. And for deliveries, you may also be asked to uh, provide allowance for freight class. Freight is the amount that you will have to pay in relation to the delivery of the goods. Okay. And again, another reason why the discussion on journal entries would be heavy and plenty class is because even for the same transaction, the practice in accounting has developed multiple methods class to account for the different transactions I have mentioned. Okay, for allowance for doubtful accounts class, there are a lot of methods that are acceptable and used in practice to record and account for allowance for doubtful accounts. The same is true for your uh, discounts. The same is true for your returns and allowances class. And I am not very excited to discuss those things class because journal entries are not going to come out in the board exams. But these topics, this discussion on journal entries class is important, especially if you intend to practice as a bookkeeper. You will have to be familiar with these journal entries. But as far as the board exams are concerned, as far as your part or your qualifying exam is concerned, rarely will you be asked to provide journal entries. Okay, and that is an and that is an understandable consequence of the format of your board exams, because your board exams are multiple choice questions, man. So rarely will you be asked for journal entries. But there's actually practical use in discussing these journal entries class. Okay, but as you go along your study of accounting class, you will understand and realize that indeed accounting is an art. There is no hard and fast rule for the journal entries, so long as you'll be able to arrive at the correct amounts that will have to be reported in your financial statements, so long as the balances that will appear in your ledger would be compliant with the standards, then everything will be fine. Okay. It's the output that matters, class, rather than the uh, steps that led to the amounts that you would present in your financial statements. That is important. Anyways, we really have to go through these things, especially you are still first years and you have to be familiar with all these things. Okay, so if you've gone over your textbook class again, it has introduced you to different kinds of receivables class. Okay, our main umbrella would be your receivables, and your receivables may either be trade or non-trade receivables. And you also have different kinds of trade receivables. You also have different kinds of non-trade receivables. Our focus here first would be on accounts receivable, which is in the form of a trade receivable. And at this point, class, it's important for you to know that accounts receivable will be considered as a current asset, because if you remember the definition of your current assets class, these are the assets that are expected to be used, realized, consumed within 12 months from the reporting date, or your normal operating cycle, whichever is longer. And your normal operating cycle class, as defined in PAS 1, will include the time in which it will take you to collect your receivables from the sale of your goods or from the rendering of your services. So, by definition itself, class, since accounts receivable arises from your primary business operation, the normal collection period of your accounts receivable will normally coincide within your normal operating cycle. So in any case, your accounts receivable will end up being classified as a current asset. And that would be perhaps your first important takeaway for today, class. That your accounts receivable will have to be reported or classified as a current asset. Your non-trade receivables class will be classified either as a trade or as either a current or non-current asset, depending on the period of realization class. Okay, but your accounts receivable and your trade receivables will normally be considered or classified as a current asset. Uh, in identifying whether certain non-trade receivables will be classified as a current or non-current class, again, you will have to consider the nature of these receivables class. Are they normally realizable within 12 months or the operating cycle, or are they expected to be realized beyond 12 months or beyond the normal operating cycle? If it's the latter class, then it should be a non-current asset. If it's the former, then it will be current asset. Okay, but in most cases, the problem will not be explicit class. The problem will expect you to have uh, knowledge on the default classification of this kind of receivables class. So it's important that you will be familiar with the different kinds of non-trade receivables and their corresponding classification. At this point, you need not worry. We will deal with them as we encounter them in the problems, and we'll explain why they are normally classified as a current or a non-current receivable. Okay, but expect that that would be uh, a significant part of your expected learnings for this topic class, that you will be able to classify receivables as whether current or non-current. You will be encountering a lot of problems wherein all that will be asked from you is to compute for the total receivables that would be classified as a current asset and compute for the total receivables that would be classified as non-current assets. And the computation would be very simple addition lang class. But for you to arrive at the correct answer, you must be able to make the correct classification. This kind of receivable is current asset. This kind of receivable is non-current asset. Okay? And we expect you to be, by the end of the discussion on accounts receivable, we expect you to be able to answer those kind of problems. Your book mentions also of customers' credit balances class. The takeaway here is that customer credit balances will not be presented together with your accounts receivable. For you to understand that statement, you must understand first what customers' credit balances are. You remember, class, that your accounts receivable, your customers' accounts, is normally will normally have a debit balance, being an asset. Okay, but the scenario here is that the accounts, or the account of your customers class, the account maintained by your customers with you, becomes credit class, or in some sense becomes a negative amount. And the question now is, how do you treat these negative receivables? How do you treat this negative amount? Are you going to deduct this from your other receivables? When computing for your total receivables, will negative receivables be a deduction to your other receivables? And the answer is no. The rule is, if you have credit balances, in your receivables class, they should not be charged or set off against your other receivables. They should not be set off against uh, accounts with debit balances, but instead report them as a liability. Okay, which leads me back to the most important question here: when do you have credit balances in your customer's account? Okay, supposedly, if your customer owes you 1 million plus and he pays you 1 million, then your entry would be debit cash and credit accounts receivable. And after that entry, the balance of your customer's account would be zero. When then will it be? When will then when then will the balance of your customer's account be negative or will have a credit balance? It will normally happen, class, if there will be an overpayment. Okay, if your customers make overpayments, class, or your customer paid in full in advance but later on made returns, of course, since there was full payment already but subsequently your customers returned some of the goods that they have purchased, it would result in a negative or a credit balance to the customer's account. Okay, in that case, do not charge them off against your other accounts receivable. Recognize them as a liability. And recognizing them as a liability, class, makes sense because if your customers made an overpayment, class, then that actually means you now have an obligation to your customer to return the overpayment. If your customers returned goods which were already fully paid, then you actually have an obligation to return to your customer the value of the goods that were returned. So that is why the correct treatment, class, for a credit or negative balance to your customers' accounts would be to recognize them separately as a liability and not to charge them off against your other receivables. Okay, I hope that's clear. That is important, class. That is worth mentioning because in problems, class, asking you to compute for total receivables, some students would deduct the negative balance. Some students would deduct the credit customers' accounts with credit balances from the other receivables class. And that's how they would get the wrong answer. Because you're supposed to ignore the credit balances in your receivables account class. When you are asked to compute for class, I hope you're taking note of this thing I'm talking about class. When you're asked to compute for total receivables class, supposedly your task is just to add everything and not to deduct receivables with negative or credit balances. It is supposed to be ignored, and the reason being, it is not going to be offset against other receivables, but instead it would be uh, recognized separately as a liability. Okay? This should not be a very difficult thing to remember. Credit balances or negative balances in your receivables accounts, in your customers' accounts, should not be deducted from your other receivables, but instead recognized separately as a current liability. Why will it result in liability? Because the reasons that will cause a credit balance to your receivables class will actually result in an obligation on the company's part to return or make refunds to the customers class. Okay. I hope the concept behind credit balances on customers' accounts is clear. Moving on, class. Another important takeaway for you should be the initial measurement and subsequent measurement for receivables. Uh, Accounts receivable class, just like any other receivable, is to be initially measured at fair value. Okay, but since the term surrounding your accounts receivable class is only for a short term, supposedly the fair value will represent is going to be the present value of the cash flows that you will expect to receive. Again, accounts receivable class represents a right to receive cash. And if the standard tells you to measure the asset at fair value class, you will have to understand that the fair value will represent the present value of the cash flows that you expect to receive. Okay, but that is not very important when we are dealing with accounts receivable class, because normally the fair value class, the fair value of your accounts receivable will just be the same as the invoice price class. If you are selling goods at the price of 1 million, then the corresponding accounts receivable will initially be recorded at 1 million. And why will it be at 1 million class? Because you're supposed to recognize your accounts receivable at its fair value, and its fair value will be the present value of the cash flows that you will expect to receive. And what is this cash flow that you will expect to receive in our example? It is the 1 million. Okay, going back. The scenario is you sold something for 1 million. How much accounts receivable will you be recording? You will be recording accounts receivable in the amount of 1 million. Why is it 1 million? Because the 1 million class is the amount that we expect to receive. Okay? But I thought the rule was to get the present value of the cash flow that you expect to receive. That is correct. But when we are dealing with accounts receivable, the term is very short, class, wherein the present value will essentially be the same as the original value class or the original invoice amount. If the invoice price is 1 million, if it is payable within 30 days, the amount of discounting class, the amount that you would get after discounting, the amount of interest, the amount of implied interest that you will have to remove would be very immaterial, class, to the point that there is no use in discounting the 1 million anymore. And that has actually become the practice, class, when dealing with accounts receivable. Even though the rule is to get the fair value, which should be the present value, the practice now is to simply record it at the face value of the transaction or at the invoice amount. Okay? So again, supposedly you're going to get the present value of the 1 million. But because of the short period of time in which the customer has to pay the accounts receivable class, the present value would end up almost the same as the original invoice amount. Okay, the amount of interest, imputed interest included in the 1 million is so material that we can actually forego the discounting process. Okay. For other receivables class, we will really have to apply discounting class. I hope everyone is familiar with discounting, the application of the time value of money class. But here, because the period involved is so short, class, the amount of imputed interest would be considered immaterial to the point that there's no point in applying discounting anymore. So in short, your takeaway would be when asked how are accounts receivable uh, measured, class, They are supposed to be initially measured at fair value, and it's just that their fair value would just be the same as their transaction price class. Okay, supposedly fair value would be the same as present value, but again, when dealing with accounts receivable, the fair value or the present value will end up being the transaction price, which would be normally the invoice amount or the invoice price of the goods that were sold. Okay. For subsequent measurement class, as theory, if you're asked how are receivables subsequently measured, the answer would be at amortized cost. Okay. That is true even for accounts receivable. It's just that the application of amortized cost for accounts receivable is different from the amortized cost from your other receivables class. Okay. But again, if you're asked with a blanket question class, how are receivables subsequently measured? They are subsequently measured at amortized cost. But if you're specifically asked how are how are accounts receivable subsequently measured? The answer is accounts receivable are measured at their net realizable value. Very important. This should be your third takeaway today, class. That accounts receivable are subsequently measured at at net realizable value, or NRV for short. Please be familiar with the term NRV, class. NRV stands for net realizable value. Again, receivables in general are subsequently measured at amortized cost. Specifically, accounts receivable is subsequently measured at net realizable value. Does it mean that the subsequent measurement of your accounts receivable violate the general provision in PFRS 9? The answer is no. It's just that as far as accounts receivable is concerned, its amortized cost is its net realizable value. Okay. So the reason that accounts receivable is subsequently measured at net realizable value is because its net realizable value represents its amortized cost. Okay. Again, I cannot emphasize how important that is as far as theories are concerned. They are initially measured at fair value. Okay, and their fair value is supposed to be their present value, but as far as accounts receivable are concerned, the present value, the fair value will normally be the transaction price, which will normally end up as the face value of the transaction, or simply the invoice price of the goods that were sold. In arriving for your notes receivable class, you basically start with your gross receivable and deduct all other deduct allowances that are normally involved in the maintenance of an accounts receivable. And what are these allowances, class? You have your allowance for freight charge, allowance for sales returns, allowance for sales discounts, and allowance for doubtful accounts. The accounting for these allowances are the main reason why we will have to deal with a lot of journal entries in our discussion with accounts receivable. Okay, we'll deal with the journal entries as we encounter problems involving these related accounts. I hope in your basic accounting class you have already started discussing on the effects of the shipping arrangements class in the journal entries that will be prepared involving a sales transaction. Another reason why there's a lot of entries that will be discussed here, class, because again, different methods are available to us, class. For example, in accounting for discounts class, we have two methods, your net method and your gross method class. And depending on the method that will be used, the account titles that we will be maintaining will also be different. Okay? And you're expected to know the different entries that will be prepared under those two methods. Also, for accounting for your bad debts class, for your allowance for doubtful accounts, not allowance. The allowance for doubtful accounts becomes relevant when you are using the allowance method. So when dealing with potential bad debts, when dealing with potential worthless receivables class, again, we also have two methods, the direct write-off method and the allowance method. Supposedly, the direct write-off method class is no longer allowed, but for some reason, textbooks would still discuss the direct write-off method class. And because textbooks discuss the direct write-off method, you would still be able to encounter these problems, and that is why you're still expected to know the direct write-off method. Because textbooks provide questions involving the direct write-off method class, there's an expectation that it can also come out in the board exam. And since it is possible that it will come out in the board exam class, we are left with no choice but to discuss this method, even though, again, this is no longer allowed. Okay, proceeding with problem 4-1 class. Can you scroll it down so that we can see the questions, please? Okay, compute. Let's focus on the second requirement. Compute the amount to be presented as trade and other receivables class. So basically, the task here, class, is can you scroll it up again? Our task here, class, is to identify which of these items will be classified as a trade receivable, which of these items would be considered as which of these receivables would be considered current assets, which of these would not be considered as non-current assets. Okay, so here we will have to discuss whether these accounts are normally classified as a current asset or a non-current asset class. Okay, so we'll have to go through them. We'll have to determine, class, whether they would be included in our determination of trade and other receivables that will be classified as a current asset. The scenario here, class, is that the company maintains a single account for every kind of receivable. From that alone, class, it tells us that the company is doing something wrong already. You're not supposed to maintain one receivable account for all kinds of receivables. But since that was the practice of the entity class, we are left now to correct the mistake of this company. Okay. First would be your trade accounts receivable. And the question is, will this be included in your trade and other receivables that will be classified as a current asset? The answer is yes. Again, if it's an accounts receivable, it normally arises from your regular business operation and therefore expected to be realized or collected within the normal operating cycle and thus should be classified as a current asset. Let me start calling na lang. Lampago.
Yes, sir.
Will your trade notes receivable be part of your trade and other receivables?
Yes, sir, because notes receivable is a current asset and it also arises from the normal operations of the business.
Okay, and we know that because it was expressly classified as a trade receivable, a trade notes receivable. Okay, how about another question for you? How about the installment receivable? Mr. Lampago?
Sorry, sir. For installments receivable, sir,
Yeah.
I think it is a current asset as well, sir,
It
and it
was
should be classified because I because I think there it is reduced by monthly payments and also arises from the normal operating activities of the business.
okay, that's correct. Give me number between 1 to 40, Mr. Lampago.
Number 5, sir.
Apali? Okay. How about the customer's account reporting credit balances? Will it be included in our computation? Customer's account reporting credit balances. Customers account reporting credit balances arising from sales return. Will that be included in our computation of total trade and other receivables? Because why can you not speak, Ms. Apali? Mr. Lampago, give me another number between 1 to 40.
7, sir.
Blancha,
Yes, sir.
do you
Um,
agree with your classmate's answer?
I think, sir, it is sir, current asset, sir, and it's a trade, sir, because of the word, excuse me, sales return, sir.
Yeah, but
Right, sir.
what did we say earlier about credit balances? Are we supposed to deduct it from the other receivables?
Although, although it states, sir, nga kanang it should not be offsetted because arises from liability, siya, sir, but
Yeah.
because of the word sales return, sir, I think it is a current asset and a trade, sir, part of trade.
No, even then, uh, your sales return will be the normal source of your credit balances. Okay, we will stick to what we have discussed. It should be reported separately as a liability. So it should not be included in our computation for current trade and other receivables. How about advance payments for purchase of merchandise, Miss Blancha?
Sir, non-trade, sir. It does not it's not it does not usually wait because, sir, kanang it does not usually although it is part of kanang for a minute, um it it does not involve a transaction between customers, sir. That's why it is it is non-trade, sir. When you say non-trade, when you say trade transaction, sir, it usually involves between customers transaction. That is what I learned.
Yeah, but the question here is not just trade, actually, Miss Blancha. The question here is trade and
Non-trade.
there's
It should be a concern.
the
Should
primary
be included.
concern here is not our primary task here is not on determining whether it is a trade or non-trade, but our task here is in determining whether it should be a current or non-current. I
I
understand your reasoning that since this is between us and our supplier, then this should not be trade. But the issue here is whether this will be a receivable or not. This will be a current asset or not.
current, sir. It usually arises in the normal transaction of business.
So what are you saying? Advance payments to our suppliers will be
A current asset.
a current asset. That's correct. Okay, thank you. Uh, so just to expound, class, advance payments, class, for purchase of merchandise is actually the opposite, class, of our credit balances in customers account. This time it is in the books of our supplier, wherein there will now be a credit balance on our account. Since we are the one who made an advance payment, our supplier now has an obligation to us to make deliveries. And on our part, we have a receivable class. We have the right to receive inventory or goods from our supplier. So obviously, this is a different kind of a receivable class because what we are expecting is not to receive cash, but to receive supplies or inventories or merchandise from our supplier. But since this is between us and our supplier class, and we are regularly engaged in business with our supplier, this would be considered as a current asset. Okay. Again, in this transaction, we are not the one selling klasa, we are actually the one buying from our supplier. Okay. And I will understand if you are still confused because we are somewhat, there is now a crossover between the discussion in inventories and accounts receivable. Here we are actually the purchaser. It's just that we have made advance payments and our advance payment will be considered as a receivable on our part. A receivable not necessarily representing a right to receive cash, but a receivable representing a right to receive uh, merchandise or inventory in the future. And this is what makes your receivable account unique class. As what I've mentioned, you will have different kinds of receivables. Okay, not all kinds of receivable will involve the receipt of cash only. Okay, you may have receivables in the form of uh, inventories class. What you will expect to receive are inventories instead of cash or money. Give me a number between 1 to 40, Miss Blancia.
14, sir.
14 is zone.
Hi, sir. Good afternoon, sir.
How about the next one?
The customer's account reporting credit balances arising from advance payment, sir.
Yes.
It is not a current asset, sir, under the trade and other receivables, sir, since it is classified as a current liability and included as part of the trade and other payables.
I think that's correct. How about the next item? So basically the same explanation as the earlier credit balance class. Next. Still you, Ms. Kizon.
The cash advance to subsidiary, sir, should be classified as a non-current, sir, and presented as a long-term investment, sir. So
Okay.
it is not included in the current asset.
So your cash advance to your subsidiary class would be normally classified as a non-current asset class. This is a form of a non-trade receivable and one that is going to be classified as a non-current asset. Please remember, class, this kind of account will normally be involved in problems involving classification of receivables, whether current or non-current. Okay, advances to subsidiaries would be considered as a non-current asset. Thank you, Ms. Kizon. Give me a number between 1 to 40.
18, sir.
Enzo,
Yes, sir.
claim from insurance entity.
It is considered as current asset, sir.
Okay, that's correct. Okay, but again, class, this can be varying in class. It depends on the problem. Next, about subscriptions receivable. Still you, Miss Estenzo.
Okay, sir. Still current asset, sir.
Because
Because it is still included in the normal operating cycle of an entity.
not really part of your trade receivables, but since it is due in 60 days, since it is expected to be realized within the next 12 months, or in this case, in the next 60 days, then it would be considered as a current asset. And
Yes.
thank you, Mrs. Stenzo. And this is what I want you to remember, class. Very important. A lot of students would get this wrong. The classification, class, or the treatment for your subscriptions receivable can come in two ways. Number one, if it's collectible within 12 months, class, then it would be reported as a current asset. Okay? If it is expected to be collected beyond 12 months, class, the classification will not be as a non-current asset. Again, this is where students get it wrong in class. Because of course, our normal expectation is if it is expected to be collected within 12 months, obviously current. And if it's not expected to be collected within 12 months, then obviously non-current. But subscriptions receivable is unique. Okay? By the way, where will your subscriptions receivable come from, class? This will arise from the issuance, class. Okay, the offering for sale the shares of the company. Okay, if you are offering your shares, class, to potential shareholders, okay, when they make e-subscriptions, if they have not yet paid, then the balance would be considered as a subscription receivable. And again, the subscriptions receivable would be very unique. The treatment is to record them or recognize them as a current asset if collectible within 12 months. But if they are collectible beyond 12 months, class, the rule is it would be treated as a deduction to your shareholders' equity. Okay, many students would forget that one. They would think that if a subscriptions receivable is collectible beyond 1 year, that it would be a non-current asset. That's wrong. If a subscriptions receivable is collectible beyond 1 year, then it would be a deduction to your shareholders' equity. Okay, that's very important, class. If there's a single takeaway for this problem, class, let it be the treatment of your subscriptions receivable. I cannot emphasize that enough, class. Okay. Moving on, accrued interest receivable, obviously a current kind of receivable. So far we have 775, we have 100,000, we have your installment receivable in the amount of 300,000. Then you have your advances to your suppliers in the amount of 150,000, and then we have our claims receivable in the amount of 15,000. The current subscription receivable in the amount of 300,000, and your accrued interest receivable in the amount of 10,000. But please do not forget to deduct your allowance for doubtful accounts, which is provided in the second sentence in the problem in the amount of in the amount of 50,000, and therefore our answer should be 1,600,000. Our answer should again be 1,600,000. What's the third requirement? For those that were excluded, what were excluded, class? The advances to subsidiary, which is again a non-current, and then the credit balances, which are to be reported as current liabilities. Let's proceed to the next problem. Ms. Estenzo, give me a number between 1 to 40.
Number 33, sir.
Bilon.
Yes, sir.
Okay. The issue in problem 4-2 class is that again the company used a single account, class, for all. We're just given with a T account, class, and we are left to determine how much would be the correct balance of our accounts receivable. And it's not as simple as getting the difference between the total debits and the total credits, class, because there are postings in our T account that are not supposed to be posted to the accounts receivable ledger, class. Okay, if you're looking for the ending balance, class, and you're already given with the T account, uh, supposedly all that we will have to do, class, would be to get the total debits, get the total credit, and compare the two amounts. Okay, but the problem here is we cannot rely on the postings on the debit side and the credit side because it includes items that should not have been posted in the ledger or the account of your accounts receivable. So our task is to sort through all these postings and limit only or take note only of those that will actually involve our accounts receivable account. Okay, so your task, Ms. Sumbilon, would be to guide us on how to compute for the correct ending balance of our accounts receivable. Where should we start?
Sir, credit accounts receivable, sir, 600,000.
We start with the beginning balance, okay? The January
Yes.
balance in the amount of 600,000. And
Yes,
then,
sir. And add charge sales, sir,
what's your
6
understanding
million.
of charge?
Credit, sir, 6 million.
What do you mean credit?
The credit, that is the credit balance for charge sales, sir. Add it for the accounts receivable, sir, January 1.
Oh, okay. So if if we will try to reconstruct the entry that resulted in a debit posting to our accounts receivable in the amount of 6 million, what do you think was the entry, man?
Again, sir.
Diba, in this T account, you can see on the debit side, charge sales 6 million. Okay.
Yes, sir.
So for there to be a posting of 6 million in the debit side of this T account, what then must have been the complete entry? Let's try to reconstruct the entry that resulted in this debit posting.
It will increase, sir.
Let me clarify my point. Class, you remember in the accounting cycle, class, the first step would be analyze the transaction, second, to prepare the journal entries. Okay? And after preparing the journal entries, if you remember, the next step is to post it in the ledger. And an alternative way, class, instead of posting it to the ledger, we can actually just use your T accounts. So what we have here is a T account of your accounts receivable. And in the debit side, class, there is a posting of 6 million representing charge sales. So if you can see a debit posting in the T account for accounts receivable, class, that means there was a journal entry wherein accounts receivable was debited. So what I'm asking now is, give us the complete entry. If there was an entry debiting accounts receivable in the amount of 6 million, based on the other information available to us, what do you think was the credit ni Sombila? Are you still there?
Sir, debit accounts receivable 6 million, then credit sales, sir, 6 million.
Okay, that's correct. That's the correct credit. And that transaction can be described as a sales on account. So the 6 million represents the amount of sales that we have that was on account. Okay, continue. You started with 600 and you said we will add 6 million. What's next?
The total would be, sir, is 6,600,000, sir.
And then,
And then minus collections from customers, credit 5,300,000, sir. Then
what do you think was the entry there?
sir.
We know that accounts receivable was credited because it was posted on the credit side. What do you think?
Sir, debit debit sales 5,300,000, then credit cash accounts receivable 5,300,000, sir.
No, the credit should be accounts receivable because it's posted on the credit side. And class, never debit sales, class. Never debit sales. Debit only sales if it's a correcting entry. Okay, income account should only be credit.
Okay. Okay, sir.
Expense account should only be debited.
Okay, I know na, sir.
Okay.
Debit cash, sir, 5,300,000. Then credit accounts receivable 5,300,000, sir.
Okay, that's correct. Because I hope you're able to come up with these same entries, class, huh? And then, aside from the 5,300,000, what else are we going to do?
Then add the kanang answer. Less write-off, sir, 35,000, sir.
Okay, because if you
In
have
the debit side, sir.
because your write-off will reduce your accounts receivable. Okay, and then
Yes, sir. And then minus merchandise returns 40,000, sir. In the debit side again.
what do you think was the transaction here? What
Because
happened here?
it will decrease the accounts receivable, sir.
Okay, our customers returned our merchandise. Okay, and as a result, our receivable will decrease.
Yes, sir.
And then
Yes, sir. And then minus allowances to customers, sir. Debit.
how much is that?
25,000, sir.
And what else?
And the total would be 600 the total would be 5,400,000, sir. Then after that, you will get the accounts receivable for December 31, 6,600,000 minus 5,400,000, sir, is equals to 1,200,000.
Okay. Thank you, Ms. Ambila. Give me a number between 1 to 40.
Number 39, sir.
Julia Senso.
Yes, sir.
Okay. We have here the T account for your accounts receivable as provided by the company. When your classmate was asked to compute for the correct ending accounts receivable, she told us that out of all these debit and credit postings, only the following are relevant. The January 1 balance, 600,000. The charge sales, 6 million. The collections from customers, 5,300,000. The write-off of 35,000. The merchandise returns of 40,000. And the allowances to customers of 25,000. But there are still a lot of other postings here. What are we going to do with these postings? Why are they not included in the computation for the ending balance of your accounts receivable? Why do you think, Villasencio?
Um, they're not included, sir, because in the it was written here, sir, in the oh no, so
Because they were wrongly posted or included there. They should not have involved the accounts receivable. All the other postings there, class, involve a different kind of accounts. So your task, Mr. Villasencio, would be to tell us if these items are not supposed to be in our accounts receivable ledger, where should it go? First, shareholder subscriptions, 200,000. Can you see that, Mr. Villasencio?
shareholder subscription, sir. It should be put in the shareholders account, sir. Capital account, and I mean debit, cash, and credit
But one thing is for sure, it should not be part of our accounts receivable, correct?
Yes, sir.
Okay. So we have shareholder subscriptions. It should not be part of accounts receivable, and we are already familiar with the subscriptions receivable account. The question now is, should it be recognized as a separate current asset, subscriptions receivable, or a deduction to your shareholders' equity? How should the 200,000 be presented?
It will be presented as a subscription receivable, sir.
Yeah, but as a current asset or as a deduction to your subscribed share capital?
Um, as a current asset, sir.
Why current asset? What did we say earlier? Thank you, Mr. Villasencio. Let me just finish this na lang. Okay.
Yes, sir.
It's a current asset if it is expected to be collected within 1 year. And another important takeaway, class, if the problem is silent, subscriptions receivable will be a deduction to your share capital, class, your subscribed share capital. When will it be current asset? Only if the problem expressly states that it is expected to be collected within 1 year. If the problem is silent, it will be a deduction to your subscribed share capital, a deduction to your shareholders' equity. Okay, and since in this problem, the problem is silent, class, then it should not be reported as a current asset, but instead a deduction to your subscribed share capital. Next, deposit on contract, class. We are again sure that this should not have been included in our accounts receivable because this did not arise from our regular business operation, class. Okay. And another new thing you have to absorb, class, that deposits and contracts should be classified as a non-current asset. Because normally contracts, class, would be for a long period, so it's expected that the deposits would also be outstanding for a long period of time. So basically, we have entered into a contract, class, and the contract requires us to make a deposit, class. Let's say, for example, I can think of a specific contract, but it's very common, class, for one of the parties to be required to make a deposit, and the deposit can only be recovered at the end of the contract, class. So since normally contracts go beyond 1 year, class, contracts that will require separate recognition go beyond 1 year, so it will follow that the deposit related in that contract, which can only be recovered at the end of the contract, will be reported as a non-current asset. Claims against common carriers for damages, normally claims would be considered as a current asset, class. IOUs from employees, advances to employees, or receivables from employees, class. I hope you are familiar with IOUs, class. I hope you know what IOU means. IOU, O as in OWE. Ako utangan nimo. So if it's an IOU, from employees, it is the employee that owes you. Okay, you as in YOU. So and thus it is a receivable. Definitely not an accounts receivable, but still a current uh, current kind of receivable. It will be reported as a current asset. Okay. Advances, cash advance to affiliates, class, again, not part of accounts receivable. This is a different kind of receivable, specifically advances to affiliates, class. And this one is something new. Once again, advances to affiliates, class, are normally classified as non-current assets. Please remember that one. Unsa ba tong lain, class? Advances to subsidiaries, and now we have advances to affiliates, which is normally classified as a non-current asset. Advances to a supplier, class, again, a form of a receivable but not an accounts receivable. But since this is between us and our supplier, this would be considered as a current kind of receivable. So therefore, treated as a current asset. Okay, and then That's it. Okay, everything else will no longer require recognition of as a receivable class. Let me just end the recording. We will continue next week, class. Still on the